Imagine this. The market drops 30% in 3 months. Headlines scream, stocks are on sale, and you can't buy a single share. Not because you don't believe in the future, not because you're scared, because you're fully invested. Every dollar already committed. No cash. That's the part nobody likes to talk about. We're told cash is lazy. Cash loses to inflation. Cash does nothing. But here's the uncomfortable truth. Cash doesn't exist to grow. It exists to give you options. And options are power. Right now, most investors are trained to deploy everything. Max out the brokerage account, max out the retirement account. Automate, invest, forget. It sounds disciplined. It feels productive. But zoom out. Markets move in cycles. They always have. In 2000, the dot-com bubble erased nearly half the S&P 500. In 2008, global markets fell over 50%. In 2020, we watched a 34% crash in just weeks. Each time, the same pattern. Prices collapse, fear spikes, assets get mispriced, and the people with cash, they become buyers of opportunity. Here's how the system quietly works. When prices fall, forced sellers appear. Funds face redemptions. Investors panic. Companies with weak balance sheets scramble. They don't sell because they want to. They sell because they must. Liquidity disappears. And liquidity is just a complicated word for this. Who actually has money available right now? If you do, you set the terms. This is why professional investors obsess over liquidity. Warren Buffett's Berkshire Hathaway has held tens of billions in cash at various times. Not because they forgot how to invest, because when the right deal appears, speed matters. Cash compresses decision time. It turns volatility into leverage. Now here's the irony. Everyone says buy the dip. Almost nobody is structurally prepared to, because they optimized for maximum exposure, not maximum flexibility. There's math behind this. If your portfolio drops 50%, you need 100% gain just to break even. But if you deploy cash after a 50% drop, your starting price is lower. Your required recovery is smaller. Your upside is asymmetric. Cash reduces the damage when things fall and amplifies the opportunity when things are mispriced. But the hidden mechanism is psychological. When you're fully invested and markets fall, you feel trapped. When you hold cash, you feel patient. Patience changes behavior. Behavior changes outcomes. Of course, cash has a cost. Inflation erodes it. In a 5% inflation year, idle cash loses purchasing power. That's real. But so is the cost of being unable to act. The system rewards those who can survive long enough to exploit volatility. Hype tells you to stay fully invested at all times. Reality whispers something quieter. Control matters more than constant participation. Cash is not a long-term asset. It's a strategic position, a buffer, a call option on chaos. And in a world where markets are increasingly driven by leverage, algorithms, and crowd psychology, chaos is not rare, it's routine. So the question isn't whether cash grows fast. The question is this: when the next forced sell-off happens, will you be watching it or buying it?